So what is the evidence that there might be a lag? Well, a couple of things, and it really has to do with real estate, which I think is the most impacted asset class by rate hikes. You saw that the mortgage rate is the highest it's been in over 20 years. One major real estate guy told me that the big guys like, Blackstone, the words he used was they are throwing their keys at the bank, meaning they are so underwater, they're not even going to bother trying to figure out a workout. They're just going to give the key. They're just going to say to the bank, you own this asset now, and they're going to move on to the next fund.
Experts have been warning about an imminent crisis in the U.S. real estate industry over the past year. When the Federal Reserve embarked on what promised to be an aggressive rate hike in 2022, many prominent investors and analysts warned about how that will impact the real estate industry, which is usually one of the industries most impacted by rising rates. Since then, the central bank has effected 11 rate hikes, the fastest pace in history, taking the Fed funds rate from around 0% in early 2022 to a range of 5.25 to 5.50% in July 2023. In addition, the Fed has hinted that there might be more rate hikes with no chances of rate cuts anytime soon. According to renowned investor and venture capitalist David Sachs, there's a big storm brewing in the real estate industry, which could spell a lot of problems for the overall economy. During the latest episode of the All In podcast, Sachs and renowned Canadian venture capitalist Chamath discussed the current state of the United States economy and the many signs of trouble ahead, despite the official narrative that the economy remains strong and resilient. Sachs points out that the market is pricing in rate cuts for as early as Q1 2024 with the belief that the inflation battle has been won. However, there is evidence that inflation could rebound and become sticky, and that the economy could still be impacted by the unprecedented rate hikes. This is why Sachs believes renowned investors like Warren Buffett and Michael Burry are betting against the market right now. Earlier in the week, news broke that Burry's Scion Asset Management has placed a $1.6 billion bet against the stock market. According to documents from the firm's 13F filing, which detail its holdings as of the end of Q2 2023, Burry has placed big bets against the SPY and QQQ ETF using put options worth a notional $1.6 billion, $739 million worth of put options against the tech-focused QQQ ETF, and $886 million worth against the SPY ETF. SEC filings also show that Warren Buffett's Berkshire Hathaway sold almost $8 billion more in shares than it bought during the previous quarter. This might not be unusual for a legendary investor like Buffett, but not when the market is up. According to the All In podcast team, the recent investment behaviors of renowned investors like Buffett and Burry is enough proof that something big is coming and the storm is just about to hit. We will now bring you clips from the discussion between Sachs, Chamath, and other members of the All In podcast team as they analyze what's coming for the U.S. economy. Please watch the video to the end, subscribe to the channel, and turn on post notifications. Also, ensure you drop your comments and observations in the comments section below. Thanks and enjoy the video.
I think we should follow up on where the economy is right now and what the macro situation is like and why Michael Burry might want to short the market.
Yes.
So in terms of where things stand today, I think the consensus view of the street is that inflation is largely in the rearview mirror. It was down to 3% last month. And the bet now, I think, is that it will continue to remain low. It will be in this 2.5% to 3% range at the end of the year. And therefore, the Fed will be able to cut rates next year. And the market has rallied quite a bit in anticipation of that. I think that is the consensus view. Yep. I think there are at least two really big risk factors to that. One is that inflation could still rebound. We haven't really gotten that many months of good inflation data. And if inflation ticks back up, if there's another wave of it in the next several months, then there will not be rate cuts next year. And that means if interest rates are higher than anticipated, valuations come down. So that would be a big risk factor to the market. The other big risk factor is, I think, in the real economy. It's true that the economy does not seem to be hurt so far by these huge interest rate hikes that we've had. However, there is typically a big lag in the impact on the real economy of rate hikes. And I think you could still see these rate hikes take effect over the next several months, and you could see a real dip in the economy, potentially a recession. And that would be a big risk factor to the markets, because right now the markets are pricing in a soft landing or no landing. They're pricing that the economy
We're just going to do a flyby.
Right. So what is the evidence that there might be a lag? Well, a couple of things, and it really has to do with real estate, which I think is the most impacted asset class by rate hikes. you saw that the mortgage rate is the highest it's been in over 20 years.
Yeah, since the 90s. Yeah.
7.09%. And the rates I'm seeing in Florida and other places, mortgages are like 8%. Well, if it's going to cost you 8% to buy a new house, and it used to be 3% a couple of years ago, you're not going to be able to afford to buy that same level of house. And you can't afford to sell your current house and buy a new one because your current house is financed at 3%. You're not going to give up that mortgage to trade into an 8% mortgage. So we're already seeing a huge reduction in the number of transactions in residential real estate. And so that means that we're not seeing a lot of fresh marks in terms of where prices are, but that doesn't mean the valuations haven't gone lower. I think that as this washes through the system, you could see a big correction in the values of residential real estate, which is most people's main asset. So I think there's a big risk factor there. The other big risk factor is on the commercial real estate side. There was an interesting article in the Wall Street Journal about distress funds are forming in anticipation of a lot of commercial real estate projects basically going under. So the vultures on Wall Street are going to be looking to scoop up these projects. I think the really interesting thing about commercial real estate right now is multifamily. Until now, the conversation has all been about office space. And we know that office space is impaired because of the high vacancy rates, that this sector just hasn't come back the same way
from home
since COVID. Right, exactly. But now we're starting to see real distress in the multifamily sector. Now, why has this happened? Because multifamily is full. There's no vacancy problem. The problem is not on the demand side. The problem is in the capital stack. So let me describe the problem of what's happened here is, let's say that you are a real estate developer who bought multifamily. You bought it at a certain price level. Let's say you financed it 2/3 with debt. You now need to go out and refinance that project because let's say you did a value add. Let's say you basically did some improvements to it. That means you didn't put long-term debt on it. You can't put long-term debt on a project that's not stabilized yet. If you want to do value add work to it, you get what's called a construction loan for 2 or 3 years. So there's a lot of real estate developers who need to go out right now and finance these projects that they bought. And they bought these projects at the top of the market. So let's say you're going out now to refinance. First of all, the rates are much higher. You're looking at paying 8 or 9% instead of the 3 to 4% that you had penciled in your model a couple of years ago. Moreover, there's another problem, which is potentially even worse, which is loan to value. You had basically gotten 2/3 loan to value a couple of years ago, but values were much higher. Now values are lower because, again, multiples have shrunk as interest rates have gone up. And so the amount that you can finance is much lower. So you either have to top that off by coming out of pocket with your own equity, or you have to go to one of these mezzanine funds. So now there's these mezz funds, they are total sharks, and they're going to charge you not 8 or 9%, but like 15%. So your capital stack has basically is completely upside down. You thought that you could borrow all this money really cheaply, but now it is super expensive. And this project no longer pencils, meaning you're underwater you've got negative leverage on the project. And so I think you're going to see, again, not just impaired office space, now impaired multifamily. And there is not, I think, a sector of real estate developer who is not in distress right now if they need financing in the next year or two.
In a recent Twitter post, Chamath analyzes just how dire the situation in the real estate industry has become. The post reads, "The U.S. housing market is in an untenable position. Rates haven't been this high in over 20 years. The implications are twofold. One, existing homeowners stay put and sit on their historically low mortgage or sell their home and own a new home with a much higher mortgage. 2, inventory of available homes for sale shrinks and the total cost of ownership closes off many Americans from owning their most significant asset and where most derive the bulk of their wealth." In his post, Chamath estimates that the situation will motivate the Fed to initiate rate cuts much sooner than they would otherwise. His post further reads, "Separately add this to the column marked where the Fed feels increasingly motivated to initiate rate cuts 1 to 2 quarters sooner than they would otherwise. If the economy stays resilient, this probably isn't until Q2 or Q3 2024, but if we slow faster than expected, we could see our first cut in Q1 2024. Let's get back to the discussion as Sachs and Chamath further analyze the situation and what it could mean for the economy in the coming months.
David, what do you do if you're long these assets? Do you just default on them and just give them back to the bank?
One major real estate guy told me that the big guys like Blackstone, the words he used was they are throwing their keys at the bank, meaning they are so underwater, they're not even going to bother trying to figure out a workout. They're just going to give the key. They're just going to say to the bank, you own this asset now, and they're going to move on to the next fund.
Well, no, my only thought around housing was that very much just supporting what Sachs just said. Like, we're in an incredibly untenable situation, mostly because as rates go up, mortgage applications go down. And so what you're seeing is just like the number of people trying to transact is very small. And so the inventory is very small. And so Sachs said it well. So I don't really have much to add, except that when you think about where this lands squarely in terms of the wealth creation that it's supposed to represent for most Americans, it's a very difficult situation.
It's frozen.
And this is, I actually think people talk about the political pressure from the White House to the Fed. And I think that this actually is probably a very powerful lens with which to look at it. And the reason is because this touches all voters in every state, across all political lines. And I think when people talk about, is the economy doing well or is the economy not doing well? And as a result, where are your political leanings? I think something like this actually represents a much larger percentage of how people represent whether they feel they're doing well than any other thing, even earnings, quite honestly, because I think that a home is just such a fundamentally visceral psychological component of safety. My only point in that was just more that this could actually, if the Fed is susceptible to political pressure, I think this is the kind of thing that pressures them to move forward the point at which they start cutting and to start to let go of the release valve, just because there's just too much pressure in the system. The problem that we have is that rates are at a near-term high. The 10-year is ratcheting up faster than we ever expected. It's rallied in terms of rates meaningfully more than anybody thought since the beginning of the year. And so now we're in this odd position where will the Fed cut? And why will they cut? And if they cut, will they cut sooner than they would have? If they hold on, is it that they just want the country to enter a recession, in which case they want to see, quote unquote, regime change? It's a very interesting set of financial and political politics that I don't think we've seen in recent years.
Yeah, well, there's a lot of real estate developers who are literally hanging on by their fingernails, and they're hoping and praying for a rate cut. The problem they're going to have is that even if inflation doesn't rebound, even if the Fed does cut rates next year, the rate that the Fed cuts is the short rate. It's basically the Fed funds rate. That's at 5.5% right now. Even if they cut that to call it 3 to 4% next year, there's no guarantee that the 10-year rate, which is what real estate developers get financed on, will move down. Right? The 10-year rate is, what is it now, at like 4.5%? Yeah. Something like that. And that rate may not come down. A lot of economists are warning about this. Larry Summers warned about this because the federal government has such huge financing needs. And so just because short rates come down is no guarantee that the long rate's going to come down. And so there may not be this relief that real estate developers are looking for next year. And again, there's this wall of debt that has to be refinanced. I'll give you an example from my own portfolio. I have a building, just to simplify. The valuation.
You got a couple of buildings, but okay. You're talking about one.
I got a building that's worth about $15 million. It's an office building, okay? There's a $9 million loan on it that is coming up to be refinanced at the end of the year. So I'm talking to the lender about rolling it over. And what they agreed to do, here are the terms. They agreed to give me $2.4 million out of the 9 secured by the building. That's it. They wouldn't roll over the 9. They'd only give me 2.4. For the other 6.6, they wanted me to post additional collateral in the form of public securities. So they basically wanted me to fully collateralize the loan.
According to recent reports from the Wall Street Journal, Wall Street firms are getting ready to scoop up commercial real estate on the cheap. Firms like Cohen and Steers and Goldman Sachs are among the prominent names raising billions of dollars for funds to target distressed assets and purchase them at a fraction of the price investors paid a few years ago. The Wall Street Journal article quotes Kevin Gannon, chief executive of Robert Estranger & Co., an investment banking firm that tracks real estate fundraising, as saying, "The last few weeks have been saying, holy mackerel, they're coming out of the woodwork." The Wall Street Journal article further states that a small but growing number of office owners have begun to capitulate, marking a new phase in the commercial real estate upheaval. It gives the example of a downtown San Francisco tower, which was bought by Clarion Partners for $107 million in 2014 and recently sold to Presidio Bay for $41 million. Rich Hill, the head of real estate strategy at Cohen & Steers, which is aiming to raise more than $2.5 billion in a new non-traded real estate investment trust, said, "There are selective opportunities beginning to arise for investors that are in a position to take advantage of weakness." Earlier in the year, Morgan Stanley analysts issued a report estimating that the commercial real estate crisis will at least be as severe as the global financial crisis. How big do you think the unfolding real estate crisis will be, and what will be the effects on the economy and the markets? Do you agree that it will force the Fed to cut rates sooner than they originally estimated? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.